Good morning and welcome to a group discussion with the Resilient management team ahead of the release of the results for the 12 months to 31 December 2023. Representing Resilient, we have Des de Beer, Johan Crick, Monica Muller, and Nick Hanekom. Just note, all guests are muted and the meeting is being recorded. To ask a question, please use the chat box or raise your hand and we will unmute you. And then with that, I hand over to Des, who will highlight some key points from the trading update, and then we will go to questions. Thanks, Des.
Great, Ridwan. Thanks for hosting us, Nedbank and Ridwan. I think generally we're happy with our trading. Sales growth of 5% in a difficult economic environment. That figure should have been better. But there were two factors that limited it. The first is Mafeking Mall. We got this hang up of being completely dominant. So Mafeking Mall is undergoing enormous expansion just to ensure its position as the dominant mall in Northwest Province, in the capital of Northwest Province, and also considerable chopping and changing and right sizing of tenants, eliminating some of the weaker tenants, dealing with oversized tenants. Edgar's is the obvious one, but there are others which I won't mention, and sorting out a few residual issues there. And that had some impact. The rental growth, I think you can see, which we'll get to later, 7.9%, so a lot higher, even with the disruption as well. I don't know if you want to go into vacancies, Ridwan. The vacancy is 1.5, below what we'd like. It just shows you how tight things are. We would prefer a 2 to 2.5% vacancy factor, which gives us more flexibility, but we just don't have the optionality. It does put pressure on for expansions and extensions, which we're resisting at this stage. We're doing some. We'd rather do changes in tenant mix than extensions, Mafeking being the major exception, where we're doing a fairly substantial expansion. We increased our, this is the dominance. So in 4 provinces, we have the that's Mina, employee number 4. So she's got special status. Sorry about that. The 4 provinces we dominate. We have the dominant mall in 4 provinces: Northwest Province, North Mafeking, Mpumalanga. Ilanga's surpassed Riverside, which I think might have had that title previously. Northern Cape, Diamond Pavilion, and Limpopo, Mall of the North. So we do like this dominant, and you have to be there in those provinces. So we can offer all the premium brands, etc., and the maximum size, the large size stores in those particular markets. I think that's maybe a good, gives you a bit of a background there.
Perfect. Okay, so jump into some questions. The first one I'll start with is the disposal on Hammerson. So you're sitting with a 1.2 billion rand, let's say a bit of a small war chest. Plans on spending that kind of money?
We're spending it fairly rapidly, lot on energy, and we're leaders in battery and other technologies that we've used. We've refined that technology. I think it's been an interesting journey. We've expanded that team. I think you've met our team. That's a very strong team. It's a really important element in the business going forward. It's not just about, I think, load shedding. I believe some of the statements made that load shedding should decline next year. It's just about the cost of electricity, to be honest with you. So it's very important to have that benefit. Solar is very economical, and you need some batteries for load shedding, and not just for load shedding, for peak shaving and all the other concepts which we have explained in the past. So yeah, I think that.
I think we've got Mahi King, which is well underway, and with expanding on the 2 batteries that we've piloted in the past, I think that's predominantly where the proceeds on Hammerson is going, as Des mentioned.
We're doing a small convenience centre in Clarksville, clearly not a long-term target market. It's really to activate the land. A little convenience centre anchored by Checkers. It's a very easy build, and we're using that, the funds, we're also at the same time using that to put all services into the remaining land. The intention is not to keep that asset. Obviously, it doesn't meet our requirements, but it's a nice way to really activate the land and with a view to selling it. A small Checkers anchored convenience centres are still in strong demand, but it's probably not core to our business.
Okay. So before we just talk on energy, you have been active, one of the more active companies regarding share buybacks. How are you thinking about that at the current share price? Is that still on the card?
I can't give you the share price, but we would look at it going forward. I mean, the problem is we all know about the outflows of some of our leading asset managers, huge outflows, and the sector's fairly depressed. The economic environment is difficult, and in some cases, we have bought back shares. I think that's been announced, so you're aware of that, and we will consider it again. We like low leverage. I mean, where our leverage sits. We like 35. We will let it go higher from time to time, particularly as we've got fairly strong growth going forward in the assets, which should reflect in the valuations. But the doors are open to share buybacks, and the shareholders have given us the approval for share buybacks. So I would expect there to be further share buybacks in the future.
Okay, good. And then just on energy, you touched on, so you're on track for 59.3 megawatts by peak by the end of December 23. What does that mean for FY24?
Maybe Johan should answer that.
Yes, apologies to everybody for not sitting in the office with the rest of the guys, but I'm down in Cape Town. I've got a meeting straight after this with the CEO of Woolworths, Roy Bakatini, which I'm quite looking forward to. On the 2024 year, we're projecting to add roughly 22.3 megawatt peak, which would then probably take us toward 38% of our total energy consumption. Most of those projects are already in either pre-construction stage, in other words, strengthening roof, etc., or going through the approval processes, either at the municipal level or at Eskom, depending on the supply authority. But we are looking good on that. I think just maybe just add that, and Des mentioned earlier that the strategy is really broadly business sustainability. We're looking to protect ourselves against the extreme increases, the effect of those extreme increases going forward. We're doing well, and part of that exercise is also assisting tenants to become more energy efficient. We're doing a lot of work there, engaging with all of the tenants at different, from corporates, the big corporates, to individual tenants. And so it's all about efficiency as well. So we can, as we go along, downgrade the size of our connections, which in some jurisdictions also carry a financial benefit. In other words, you release power back into the grid. So there's obviously an additional benefit to that for the municipal area, but a very large focus, relamping different types of air conditioning equipment as we rework tenancies, and you can see that we've been extremely active in this last period, reworking tenants, and all of those come with a revamp, and then where appropriate we change the aircon system and so forth. So we've increased our efficiency materially over the last period, and will continue to do so. Thanks.
Thanks, Johan. And you have talked to the changing of tenants in the SA portfolio, and we can just talk to there. You see a strong improvement in vacancy to 1.5%. Can you just talk to where the improvements came from, and where the 1.5% actually sits?
I think you can, if you look at individually, the biggest vacancy that we have right now is just over 2%, and that's at Jabulani. We introduced a new Pick n Pay franchise there. Franchisee, very, very well respected. It's a beautiful store. Should have seen the market reaction, if you will, the customers on the opening day, which was last week on the 23rd. The depth of the gentleman's penetration into the local market from the employment perspective is actually wonderful to see. So on the back of that, there are still some tenancy improvements on relocations and so forth. So we'll expect that one to come down. I think the nice thing is, if you look at the turnover growth in the top three provinces, Northern Cape at 11%, that's a direct result of the rework of Katu, where we relocated, downsized the Edgars, but accommodated, and that was in order to accommodate the food lovers, and a Dis-Chem, both of which are trading well. We added a Westpac there and reworked a number of the TFG brands. It's common cause that from a category perspective, the athleisure and to an extent male fashion and higher end fashion, we're not talking luxury brands, we're talking the Kurt Geiger, Spitz, Fabiani, G-Star, Pringle, those levels. We've been very active in accommodating them in a number of these centres, such as Tubatsi, Diamond Pavilion as well, Ilanga Mall. We've all benefited, or they've all benefited from the addition of these brands. And you can see that coming through in the trading performances, I think. Most of these were completed during the period of this year. So, it's not a full year's effect. It's actually quite pleasing, because obviously on the back of these revamps or relocations to expand or right size, it comes with the full upgrade of the premises, and we've been supported well by the tenants there. Checkers has just revamped their Mall of the North store. It looks absolutely magnificent. And you can see the benefit and turnover there already, and it's just about a month in. We're expanding the Checkers in Diamond Pavilion, and that also comes with a full revamp. And to put a context on it, a full revamp of a store like that, is in the region of 25 to 30 million rand. So a big commitment on the side of the tenants. In terms of further extensions, we're looking at Irene to add a Checkers there. On the back of that, Pick n Pay is fully revamped their store there, so we're also quite excited about that. It looks good, and you can also see positive reaction by the markets. We also introduced our first Yappie share in Ilanga, and we in some further negotiations with them. I can probably keep you busy for quite a while talking through all of these things, because that's all very exciting, and we're busy with a number of the other the centres reworking or planning reworks on them. Zaneng is sort of mid rework, if I can call it that. Major expansion to Truworth, Mr. Price, a lot of the TFG brands, and there's some big tenant push there. Zanin Lifestyle Centre, that Checkers trades at the same level as Hyper would, so we're looking at an extension there to accommodate Hyper, as well as the new Food Lovers and a number of other tenants such as Dis-Chem. You also see that we are quite active with Dis-Chem. We introduced them in a number of centres, Buzulutsu in apologies to Batsi in Burgersfort, Ilonga, Diamond Pavilion, so, and I think I mentioned earlier Katu. They're all doing very well. Yeah, as I said, I can keep you busy for a while. Hopefully I've given you enough color for now.
No, definitely. I can see the team's been very busy. Maybe we can talk to reversions, 7.9% overall. Can I say that, could we see this again in FY24, or do you think it's a strong performance in this period?
If you're asking for better guidance, that's...
No, not guidance. It's just operational operational metrics.
I think,
yeah. Sorry, Des, did you want to say something?
I think it's. I mean, this is not the economy is not enormously strong, but our relentless policy of investing in the centres, ensuring we've got the right tenants, will allow us to continue to outperform. So we'll continue with that strategy.
And then if you talk to the trading density growth, sorry, Jan, you wanted to say something?
No, that's fine. I'll talk about trading density as well. Just the last thing on that. As we've said many times now, we keep on reworking the portfolio as far as density, as far as rent ratios go, and we do that twice a year in depth. And this guides us. And obviously, with an arrears list on one side and performance on the other side, that's what guides us. And an underperforming tenant, the nature of retail is that it's there's a huge symbiosis. So in fact, I was at Checkers yesterday, and we spoke about the symbiosis of adding. I'm not going to go down the road now of the exclusivities, but I think people are starting to buy into the dominant centre concept. With a few provisos, make sure it remains accessible. In other words, the convenience component that's critical, not to become too big and so forth. As far as the trading densities go, I think food has been a long-term beneficiary of the current environment. People tend to splurge a little bit during periods. The Black Friday, I know you were going to ask, I would imagine, about Black Friday, but we definitely saw food or groceries being one of the big beneficiaries during this period. Reworking, as I spoke earlier about the athleisure and some of the higher end male brands, those densities are growing, and it's on the back of that the resizing and expansion projects are based. Homeware was an interesting one. It obviously grew hugely during the COVID period, because people were sort of getting out to work at home. Obviously, electronics also benefited there. So we've seen a bit of a taper down on the homeware spend, but not to the extent that it becomes worrying or that you think that it's oversupplied. I definitely think it's not at that level yet, and I think PFG read that as well when they purchased tapestry brands, Corrie Craft, Tyler Beds, and so on. Volpes doing extremely well in our portfolio, and I know as a brand. And if you don't know it, it's sort of soft linen, toweling, etc. Very good quality, very good pricing. So yeah, there's definitely some life left in that category. Electronics, I think off the base, the very high base, seems to be doing well. People seem to have been buying TVs again for a bit. We've seen some growth in that category, not as much as the others. Yeah. Thanks.
Maybe the TVs was on the back of the World Cup. But you know, just gets a bit serious. Regarding the trade intensity growth, you know, we've seen some peers saying they've seen a slowdown in the last 6 months. Is it fair to say that maybe in Resilience portfolio, not as much, given the asset management initiatives that you've just mentioned?
Thanks, Ian. John, you can
Yeah,
answer that. I don't think it's yeah.
Yeah, I think yes. No, I'll deal with that. Can you hear me?
We can.
Okay, sorry. If you go back to the principle that if the market shrinks in a difficult environment, I think we are the beneficiary with a really good quality portfolio, and that is I think that's the secret to this, is to keep on working to maintain that dominance or to achieve that dominance. And that certainly protects us in this environment where, you know, you'll see Pepcor's made some comment on their turnovers and so forth. But broadly, I think our strategy has paid off, or is paying off.
Thanks, Johan. Let's move to France, and we got a question from Paulo. Could you talk to the performance of the French assets? Have they been up to your expectations over this half?
I think France is still. I don't want to say too much because it's actually the Lighthouse hasn't put out their trading update yet. I think Justin was at MIPIM, so I think that's why the order is actually incorrect. They should go first, so they could speak about France because it's a bigger percentage of their portfolio. I think we're making a lot of progress there. I don't think we're there. So there's been substantial additional letting. We've also been quite ruthless with our approach to tenants. Some of the tenants behaved badly through COVID, and now it's all better now. It's not better for us. We're taking quite a hard line on re-tenanting and actually, where possible, removing tenants and bringing in the target tenants, which are the Inditex brands and the JD Group, that sort of company. So quite a bit of work there, but it's still a work in progress, I would say, rather than reaching our target yet. We are confident that about the progress made. The strong demand, particularly in 3 of the malls, which gives us the ability to be quite tough on non-renewals of more difficult tenants. Primark's opening in Saint-Sever. I think it's that mall in particular is going to be overwhelmingly dominant in a very broad region. It is capital of the province, and the tenant profile there is becoming extremely powerful. Strong tenant interest, particularly there. But I would say it's work in progress. We're not there yet. Yeah.
Okay. And then we have seen a few directed dealings, and we love stock tips. Can you share what supports your view on Lighthouse?
I think Lighthouse is I think I'd like firstly I think although France is work in progress, is I like where I like where France is moving, and it'll probably take a lot longer than we would like it to be, but I've got a confidence in that. I like the team. We've built a really powerful team there, and I think it's extremely good value. So at the moment, the market tends to have a very short term view of in rating companies. So I think it's been extremely cheap for some time, and I've got a much longer term view. So, and that's where it is. I'm going to be I'm looking to increase the holding further. So please don't be surprised. Where opportunities come up, I will continue to increase the holding in Lighthouse. So I like the business.
Oh, thanks. And then regarding opportunities, what is Resilience seeing with regards to opportunities locally and internationally? Are you seeing assets coming onto the market, and maybe we can talk to yields that you're seeing? If anything interests you?
I think we'd like to buy some of our partners, but more than North, they're not sellers. It's simple as that. It's not a pricing issue. It's just these are such core assets. It's like asking Growthpoint to sell the waterfront. It's not going to happen. We see how those assets, they're less obvious than the waterfront is, but they're very, very difficult to acquire. We're turning Mafeking into one of those fortress malls. We're going to, unfortunately, cannibalize a lot around it. So that's a nice strategy there. The Mafeking, the tenant profile of this has astonished us. The tenant demand just keeps growing. The tenants have read that this is the place to be. It's accessible to the taxi rank. It's on the main road. It's between the two centres. Buying out partners is difficult. Some malls, I think we would be able to buy out partners, but always at a price. So I think where we're seeing value, we're seeing some value offshore. It's a difficult one for Resilient. They've already invested in France. It's been quite a rocky ride so far in France, but I think there's a potential to look at other assets there. What Lighthouse is seeing in some of the target markets, and I'm not going to mention the countries, but we're seeing suddenly quietly a number of really top quality malls that have been on the market for probably a year have quietly disappeared. So the very wealthy, very capable people have been quietly removing them, and they do it so surreptitiously you don't realize that suddenly the market has changed quite significantly in certain countries. We don't buy secondary assets like retail parks, etc. But we're talking about some really some important properties have quietly changed hands. There were 5 that Lighthouse was looking at. 3 of them are gone, and it all happened just without no noise, just quietly, as these people tend to operate.
And then we have a question from Nazim. Maybe we should wait for Lighthouse pre-close, but can you elaborate on Lighthouse selling its Hammerson stake? Do you think they'll continue to sell down post-announcement on the sale of the value retail? And what option are there from cash proceeds?
I think at the moment the problem is, the Hammerson's been very good to us, but we did save the company from the into fate between ourselves and APG. So it's made a lot of capital profits for us, both ourselves and Lighthouse. So Lighthouse would prefer to be where we have an issue with Hammerson is their payout ratio, which is silly. They don't have a leverage problem. And we're concerned that their ambitions are to develop, which we don't like for them. We don't like it when there are really good value assets still available in Europe at well below NAV. So, and we just don't like the payout ratio, which I think was probably really arranged to enable them to do developments. So that makes them less attractive to us. But the company's in rude health, and Justin just went on a tour, so I won't steal his thunder, but in Ireland, and came back very, very excited about all the developments there. Birmingham, finally, you can hear all the lettings in Birmingham have gone extremely well. So there's a lot of good news coming out of Hammerson, and that we're aware of. But quite frankly, we would rather manage our own assets without at substantially better yields than you can get on a 65% payout ratio. We have advised the board that we would not, at 65% payout ratio, I would recommend to the Lighthouse board that we don't support them. So we think we take a very hard line there.
Thanks. And then a follow-up question from Meyer. Just based on the commentary on the French portfolio, does this imply that the previously guided 15 to 20% NOI growth for FY24 and FY25 is unlikely to be achieved?
I don't want to give forecasts, but we very, I think without getting into trouble, I think we see a really bright future there. We do like where it's heading. It's taken a lot longer than we hoped. and it's been a lot harder than we hoped. But and we need France. You know, Spain. They're very nice countries, Spain and Portugal. We like them a lot. But you do need, if you really want to access the bond market successfully in the long term, which I think is important in Europe. France is a major benefit. You know, is a huge benefit. Getting really good receptions from the banks. Lighthouse has built a good reputation with the banks, and even in a very difficult European property market, you can see the level of support they have is good.
Thanks. And then just coming back to Nati's question, what were the escalations on the renewals and the new tenant leases in SA?
Maybe I think Johan, maybe you answer that.
Renewals were at 4.6, new leases 26.5, and that's what gave us that combined 7.9.
And the escalation rates that you're achieving on those new leases?
Around 6% at the moment. So there is a lot of tenant pressure, and you know, sometimes you got to read the base rental with the agreed base rental with the escalation going forward as well. You know, so it's not a individual negotiation. Very often it's a combined negotiation. But at the moment we're sticking to the 6% level.
Thanks.
I've got a lot of sympathy for owners that don't have sufficient scale, because we've got a very concentrated market of retailers in South Africa. With some of them are extremely overwhelmingly dominant. I mentioned Shoprite Checkers, for example, and some of the clothing retailers. You know, we've really got just a small group that are the winners and the dominant players. So these are difficult negotiations, obviously, but we know what our minimums are, and fortunately, if you have the right assets and you have the scale that we have, we reach a balance.
And then maybe a question for Monica. Where do you see LTV end of the year? And then also, can you talk to your hedge expiry profile? With any of the hedges coming up, what's the strategy given current rates?
It's a bit early to talk LTV because we are in the process of looking at our valuations. So it's largely dependent on where our vals come. But it's still within our target range. The board is quite strict on maintaining that range. We definitely don't want to exceed 38%, but I don't see us getting close to 38% at this stage. In terms of the hedging, we've had 500 million rand worth of derivatives that have expired in this period. We put in a 1 billion rand cap, which would give us the benefit when the rates come down eventually. And on average, our hedge term is 3 years at the moment.
Perfect. And then at half year, you talked about Nigeria, the funding of $45 million. How is that progressing?
Very slowly. We have approached various banks. Nigeria hasn't got better; it's got worse, and counterintuitively, so it's becoming a smaller and smaller percentage of our book. We would expect further declines in valuations in Nigeria, all and surrounding countries. I think conditions are really very difficult there. So I would expect a further decline in valuation, but it's getting to the point where it's becoming quite nominal. So we're not optimistic on Nigeria at this stage, but we are in negotiation, so we can't say anything at the moment. But I'm not really. I think a lot of the moves the president of Nigeria brought in, the new president, were in the right direction. But it was so extreme that it's put the economy into shock and caused quite a bit of chaos. I mean, you go from a 25% petrol subsidy and then you go to zero. You know, you get these sort of very aggressive knee-jerk reactions. Subsidizing petrol was always an absurd concept, apart from not being very green-friendly. But you know, to go to zero, you know, it was very disruptive to the economy there. So all our malls are full, etc. But it's hurt the currency, as you'd expect, and it's caused quite a bit of disruption. Speaking to one of the retailers yesterday, and they're saying, which is the other country, that Ghana, they're expecting potentially worse. And I think it applies to a lot of West Africa at this stage. So not an exciting thing. Fortunately, slowly becoming a rounding error. But that's where we are. The big difference between us and others is that we don't have, why it's such a small item in our books, is there is no recourse to the debt. So that does help us somewhat. But anyway, let's leave it there.
And away from the macro challenges in Nigeria, from a performance perspective at the assets, is that still ticking along?
Yeah, the malls are full, but that's not the problems of the macroeconomic issues. The malls are full, and we can't, it's just the currency and other issues are very very limiting. I think the banks have gone into shock. I mean, this trying to fix everything in one day, which is what they essentially try to do, is not helpful. I don't know what the Ghanaian challenges, but it's quite a bit of noise about Ghana as well. But fortunately, we're not there.
And a question from Nazim. There was a potential sale on the cards to PIC. Are you looking to sell any assets, or have you been seen viable offers year to date?
The issue is, I think we're not really keen sellers, to be honest with you. There was the PIC is a buyer in the market, from our understanding. They are looking for better quality assets, but at this stage, I don't think it's really a priority. So we have good relationships with them, and they have huge capital inflows. We have enormous respect, particularly for the listed team, but also for the physical team. But I wouldn't expect there to be anything at this stage. We would, something may come up, and then we would approach them and take it forward from that point. Selling our existing assets, I think, is be quite hard for us. Maybe it's that maybe we do some acquisitions, and we looked at one of the development together, but that asset subsequently was, I think it was sold. We didn't progress on that. So yeah, our leverage is not at an area where we are concerned. They would, so there's not a lot of reason to be selling our assets at the moment.
And from a yield perspective, talking about selling or buying, is it making sense in the current environment given the cost of funding?
There's not. The problem is there's always a flood of secondary assets. As I said, we would buy shares from our partners in most of our malls. They're just not available for sale. They're not sellers either. That's the problem. So we'd rather have that. We don't know what else is really in the market that we would like. We don't like the metropoles. Cape Town market, we think, is very overpriced. And we wouldn't want to enter there. We like our northern provinces where we sit, and there's really very little available that would be of interest to us. So it is. That's why the expansion of Mafeking Mall, the expansion of Zanin Crossing, which Johan touched on, massive tenant demand there. So that makes a bit more sense to us at this stage.
Yeah. Okay. Now I can imagine with vacancies low, reversions high, it's hard to be sellers in the environment, especially the partners. And then a question from Pranita. Can you give us your outlook on the health of the consumer, both locally and perhaps also in your offshore markets?
Locally, Johan, maybe you speak to that. It's we can just look at our figures. Our particular consumers seem to be very strong, thank you. Surprisingly so, looking at all the challenges they face with electricity, etc. But
I think once again, it comes back to the strategy. It has paid off a little bit because there's definite pressure. We can see that. But we've been able to grow our foot traffic. That was also just under 5% growth. I think 4.9 was the real figure. Very difficult to read the broad average consumer through our portfolio. But you can sense that there's pressure. Once again, if you see the type of buying at the Black Friday events, it's mostly groceries and that sort of thing, and then a bit of opportunistic buying. Definitely see a bit of surfing on the internet, and then for the specials, and then going to the malls. The Grove, as an example, was the busiest I have ever seen it. It was 100% fully parked throughout the day. So that would sort of indicate the consumer is not so much under pressure, but I think we probably cannibalizing from somewhere else.
Yeah, I know we get some of these online retailers mentioned. Shane, I think the one is called, and which is the big South African one again?
Takealot.
Sorry?
Well,
Takealot. So Takealot, we're trying to embrace it because, and we've got a unit in Mumsmore. And we would Mamelodi. We'd actually like to roll that out because it adds additional. It would increase our dominance. We're not concerned about. We know that our target market is not very fixated with online. In fact, we can't. We've kept it going, and we supported the operator. It's actually a franchise operator, isn't it, Johan? And we would like to embrace it further, but it's just our market is not particularly, they want to look and feel and see, and it's a much more, it's a different, it's different target markets that we're in. We would like there to be more online. I mean, you can see in many shopping centres in Europe, you see the Amazon boxes, which also seem to be relatively quiet. But I mean, online's an important element. We're not concerned about it. We would rather embrace it, but unfortunately, our target customers are not. Yeah.
Thanks. So maybe the last question from my side. You're reaffirming company guidance. Can I be cheeky enough to say around 4 rand? Is it 4.10, 3.98, 4.5? Let me just throw a number and you say yes.
You've learned some bad habits from Nazim somewhere.
No, perfect.
I think you have our guidance. I think we're not bearing that at this stage. Yeah.
I can give it 10 seconds for any other questions to come through. Yes, we don't have any questions. So I think we can end off by saying, today's, I think it's your last pre-close. Wanted to host it. So just as you head off into retirement, I just want to say acknowledge and your significant contribution to the property sector. I think your visionary expertise has not only transformed Resilient into what it is today, but has left a lasting mark on the entire South African property sector. And I think we all wish you well in your retirement and hope it's filled with well-deserved joy and fulfillment.
Yeah. Thank you very much, Ridwan. It's very, very kind of you, very humbling.
Perfect.
Thank you.
Thank you very much for hosting us.
Yeah.
Thanks to the team, and thanks to everybody for dialing in.
Thank you.
Thank you, everybody.
Cheers, guys.
Right.
Bye-bye.